You're about to hear my conversation with Richard Wong, portfolio manager and team lead of Mackenzie's Condo Boutique. Today, we're going to talk about why an era of higher interest rates could serve as a tailwind for value stocks. We're going to provide details of Richard's recent bargain hunting, and finally, why European stocks could be poised for a period of outperformance. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to The Invested, a podcast from Mackenzie Investments. My name is Rajan Bansi, Head of Portfolio Construction in Mackenzie Private Wealth. Today, I'm joined by Richard Wong, portfolio manager and team lead of our Condo Boutique. Richard, welcome again to the podcast.
Rajan, good to be here with you again.
Excellent. Richard, I want to get right into the material. We're in a bit of an interesting environment here, an environment that's been, I would say, characterized with stickier inflation in the US and stubbornly high interest rates. I'm just curious, this is pretty different from the environment we've been used to over the last 15 years or so. What does this environment mean for value, say, versus growth at a high level?
We really had about 13, 15 years of zero rate environment, very little inflation, basically since the financial crisis in 2008 to the end of the pandemic. And that really favored growth strategies because discount rate was zero. So all the capital chased growth. But if you look at history prior to 2008, a decade after decade, value strategies tend to outperform. And the reason is discount rate is positive and the valuation mattered. And I think right now we're back to norm. Interest rates is positive, inflation is sticky. All of a sudden, valuation strategies work because valuation does matter, and discounting a cost of capital is positive, and that means present earnings matter a lot more than earnings 20 years from now.
Now, Richard, you're obviously a value manager, but of course, you pay attention to what's going on in the markets. Early 2025, it's been rough for a lot of the mega cap growth names that powered higher in the early 2020s. Is part of this at least related to what you just said, that the cost of capital matters again?
Well, certainly when cost of capital is positive and fairly high, then hyper growth stocks that don't have any earnings, they're expected to have earnings years and years from now, they will be under a lot of pressure. The Max 7, they do have current earnings and they do have cash flow. So the dislocations that we have seen in the last month is really about trade policy uncertainty. So it's been a very volatile environment. And not only Max 7 stocks have been under pressure, banks under pressure too, or energy stocks under pressure too. So it's been an environment where all sorts of stocks are under pressure. But that actually is an exciting period for us. As you know, we look for opportunities in out of favor stocks, beat up stocks, and we have a lot of them in the last few weeks. So when the market was fearful, we were actually quite greedy. We went on a shopping spree of sorts, and we were able to find quite a number of great businesses, great quality businesses, businesses with long-term growth at bargain prices. And we were very busy shopping after April 2nd, April 6th, April 7th. They were busy days for us in terms of picking up new positions for the portfolio.
I love the excitement, and I love that you went on a shopping spree, and we will get into that in a moment. I just wanted to ask one follow-up question because we've begun our conversation talking about the volatility in 2025 as a function of trade and tariff policy coming out of the US. What are your overall comments, not so much on the tariffs and trade, but on the overall vol and what that means for you as a value manager?
Yeah, we were tracking the volatility and the gyrations in the markets very closely. I mean, it's almost minute by minute. In our opinion, the Liberation Day that was called basically created a max risk aversion environment in the marketplace. Volatility spiked up, hedging costs spiked up, and a lot of really good businesses that had sound fundamentals, they might not even be hurt by tariffs, went down with the market. So that was really a great environment for us, we don't know, where the market's going to go. We just know valuation. So we sharpen a pencil and we look at these prices and we look at these companies and we say, look, they're 30% cheaper now compared to earlier in the year. And even if you price in a recession, what is their fair intrinsic value? And if we can buy them at a discount to that and reflecting the risks and also have solid catalysts, then we're very happy to own them for the long run.
Richard, I'm just curious with regards to the shopping spree in early April. Were there particular sectors or even sub industries that were particularly beat up where you saw the greatest value, or was it really company specific?
There were definitely more sectors that are more beat up. For example, utilities didn't get beat up. They got nothing to do with trade, so we didn't go shopping in utilities. I mean, that's just a flat sector. But the sectors that got beat up are like consumer, technology, cyclicals. So we did some shopping in European cyclicals. We really like how Europe is shaping up. It was just earlier this year that the German government announced a massive stimulus plan. Is a generational change in their fiscal policy, and yet a lot of European infrastructure industrials they got hammered. But I think later this year, you're going to see the unveiling of stimulus plans out of Europe and Germany specifically. And so there are many stocks that would be really well positioned to benefit from that. And they were down a lot. So we really like European cyclicals. We did some shopping there. Another sector that traditional value investors don't spend much time on that has been really out of favor is technology. Technology is actually one of the worst performing sectors up until a couple of weeks ago. So we did shopping in technology too, not just in the US, but some in Japan, in Asia. And in our research, uh, AI spending, AI development, user cases, they are developing positively. And we believe that we are in early innings, using baseball analogy, of the development of AI, the investment in AI. And you won't believe this. I'm able to buy AI tech stocks at cheaper valuations than banks and energy. I mean, you can't get any better than that. So we were also shopping in tech.
Richard, I only believe you because I've met you in person a number of times and I trust you. But you're right. Otherwise, I'd have a hard time believing you. So, two-part question. I wouldn't usually think that a value investor is finding value in technology. The two questions are there particular geographies that have been more hit? And second, are there particular areas in technology that you have found the most compelling ideas where maybe the market is not properly appreciating the opportunities and these companies are trading well below intrinsic value?
Yeah, there are two areas in technology that we found excellent bargains in. One is in the hardware area. These are servers, memory, storage equipment. Those areas have been depressed, and they haven't been the leading tech stocks over the last few years. But they have a major catch up to do there because as you build out data centers, you're going to need to store more and more data. And once you store the data, it's not like you keep erasing them, right? You store data, you keep them somewhere. So storage equipment and storage memory, that's something that will be required in the next couple of years. And then another area is as networking, right? You have a lot of these semiconductors in a ginormous data center. They need to talk to each other. They need to talk to storage devices. So networking is another area that a lot of money will have to be spent. And we're finding stocks in that area trading like 7 times PE, 8 times PE.
Wow.
To us, that's just kind of insane prices. Another area is more traditional semiconductors, not so much, AI type semiconductors, but traditional semiconductors, semiconductors that go into washing machines, microwaves, regular equipment, industrial equipment. They have been in downdraft for quite some time, and we're seeing early green shoots for cyclical turnaround in that subsector. So we're quite excited about that area.
That's very interesting. I actually want to go back to one of your earlier comments, Richard. You made reference to stimulus packages, and that you have recently been part of your shopping spree was on European cyclicals. Germany announced not too long ago a stimulus package in the area of a half trillion euro. Can you share or shed some light on areas or industries or even companies that you think might be well positioned to take advantage of this upcoming stimulus?
Yeah. So right now, as we speak, late April, the German election is behind us, and they're still in the midst of forming a government. As you know, in Europe, to form a government could take a few months. So it'll be later this year before they'll get around to talking about specific spending plans. So there are certain leaders in European industrials that are going to be poised to benefit in many different ways. So, for example, we've owned Siemens for some time, and we continue to really like it. I mean, this is Siemens. People don't know this is the largest industrial software company in the world. Siemens is not just about boxes; they're big on digital automation, software, and is certainly a German national champion. So we think something like a Siemens, which we own and which we added to, will do very well. Also, the train system, passenger train system in Europe is getting dated, old, and they need to be retrofitted. They need to be upgraded to be digital and to be greener, and to use later to use some autonomous driving features and so on. So Alstom, which is a French train manufacturer that we own, it's a very compelling opportunity, trading at about 11 times PE. We believe that upgrading the train system in Europe and Germany makes a lot of sense. But there are also other German companies that are very interesting. You could be involved in shipping, also areas in terms of like distribution, equipment, hardware, or electrical system distribution. So those are some of the new areas that we got into very recently. Can't talk about the names yet. We like Daimler Trucks, which is the world's largest heavy and mid-size, commercial trucks and heavy-duty trucks. And there's a upgrade cycle going on there, and that stock is trading at single-digit PE. A third of the company's capital is in cash, so we really like that as well.
That's very interesting, and you've shared a lot of examples. Don't worry that you can't share all of them. I actually need you to hold some back, so that way we have plenty to talk about the next time that we have you on. Which don't worry, I'm going to have it in your schedule. But I want to ask you another question about Europe. Now, correct me if I'm wrong, but my understanding is similar to Canada. The European markets are increasingly viewed as a value market. That they've underperformed for the better part of the last decade or so. We're in a different environment here, not just with tariffs and trade, but as you referenced, higher, stickier inflation and thus rates. Could we be in a period where certain markets, such as European markets, are poised to outperform because they are more value oriented?
That's an excellent question, and I would tend to agree. First of all, Europe has come a long way. The baseline economic growth in Europe has been improving over recent years. I mean, most recently, I think that the chief economist of ECB said that even with all the tariffs, Europe is not going to be in a recession. I mean, there's a lot of concern about, oh, US could be in a recession, but that's not the base case in Europe at all. And second, like I would go back to this generational change. I mean, Germany had for years and years not allowed the government to run the deficit at all. And now they're saying they take that constraint away, and also any defense spending is going to be over and above that. So that's also a very interesting setup. And thirdly, Europe is pretty close to China in terms of trade. So with the distrust for US developing, there's possibility that there might be more trade between Europe and China. And China has been in the doldrums some time. So if China reaccelerates in their economic growth, Europe would benefit as well. Now, Europe historically is traded at a lower valuation than the US because of lower growth. So if some of that changes, if US growth slows a little bit and European growth picks up a little bit, and then you have this stimulus going on, I think you could definitely see significant improvement in valuation for European securities. So we are overweight Germany by quite a bit, France, UK. We own stocks in like 10 different countries.
That's so interesting. Richard, follow up question. We've talked about your shopping spree. You've just shared what you're overweight. I'm curious, what's your typical holding period? And if you could, You don't have to give a specific example, but as you talk about the holding period, could you also share thoughts on how you would make a sell decision? Because I think we have a pretty good understanding for how you make your buy decisions.
Yeah, so we are long-term investors and we tend to own a stock 3 to 5 years. But the most important thing is valuation and the catalysts, the investment thesis, right? So as long as a valuation is still compelling and attractive, and as long as the catalyst that we bought the stock for, right? How is that valuation going to change? Those are the catalysts. Like the catalyst could be and most of the time is a combination of industry development, management execution, and macro changes, right? So those are the reasons we want to own a stock as long as they're valid and they continue to propel the valuation higher and the valuation still is compelling, then we want to own a stock. So they tend to be 3 to 5 years. So our selling discipline is basically a mirror image of those. If the valuation is stretched, we would sell. If those catalysts are no longer valid, if the thesis is broken, then we would sell. A third reason we would sell would be if there are better ideas, a stock that's at a better bargain, better quality, better bargain, stronger catalyst. We'll make trade offs in the portfolio and gravitate toward a better opportunity. So there are so many examples. I mean, there are stocks that we bought a long time ago. For example, I used a name that some of the listeners know, like we bought in 2018 SNC Lavalin in Canada for even the global portfolio. And we've continued to hold that. So we've held it for quite a long time now, 6 years. And why is that? It's because the restructuring that we look for has happened, the turnaround has happened, the balance sheet has been fixed, new management is executing, and they start to grow. Even though the stock has performed extremely well, that intrinsic value continues to lift and the catalysts are still valid. They're now doing a tuck-in acquisition strategy. They exited some of the assets that raised cash, buying back stock. So again, valuation and catalyst, they're both good. We continue to own. But on the flip side, if you own a company that might be cheap, but the catalysts are no longer there, then we'll exit, even if we own it for a very short period of time. I mean, this was about maybe 3 years ago now. We owned Credit Suisse for about less than 2 quarters. It was a really cheap Swiss bank, had a turnaround plan. We liked it, we believed it, but then compliance issues started emerging. Then there are all sorts of trading problems. So we looked really hard. We engaged the company like 5, 6 times within a few months. And we discovered that regardless of how cheap it was, the catalyst is totally broken. So we exited under 6 months. And it was a good thing we exited. We went to zero, almost zero.
Yeah, that's so interesting. Those are really great examples that really bring the process to life. I am curious. We've talked about individual companies. We've talked about the buy discipline, the process, the sell discipline. How concentrated could the portfolio be? Of course, I'm thinking about portfolio diversification, but also to make sure that the calls have conviction.
It's a focused but diverse portfolio. I mean, in the global portfolio, we have about 60 stocks. So that's diverse enough to mitigate single stock risk, but concentrated enough that the average position it's like 1.8%, 2%. And then if it's something that we feel high conviction in, it could be 3.5 to 4%. So that's how we manage the portfolio. There's a lot of different ideas. We're in 9 different sectors, 10 different countries, as I mentioned. Top holdings could be 3.5, 4%. And I think 60 is a good number. That makes it diverse enough, lowers the volatility, but make sure that the best ideas have enough weight.
That's very helpful, Richard. I have to say, I'm just curious. You are a value manager all the way down to your DNA. Value has maybe not received all of the attention over the last 15 years, but I have to say, I get a lot of questions, a lot of inquiries about value these days, and I'm sure you do the same. How does it feel to be back in the spotlight as a value manager?
My team feels great. The last few years, value is starting to deliver good competitive returns. The interest rate structure and it's definitely a tailwind for us. I'm all in. I mean, you talk about diversification. I do not diversify into growth at all. All I own is value, and all of my money is really just in the condo funds. So we're very excited. We are really excited about what this portfolio has been doing and can do. And let me tell you, those stocks that we bought April 6th, 7th, they're all up about 10, 15% already. So now the market could be bumpy and so on, but you know what? I'm almost happy if the market turns around and retests its lows again, because then I can do more shopping.
On the topic of shopping, as we've talked about in the past, there's different phases of value. You'll obviously run through them a lot more eloquently than I would. For example, like deep value, cyclical value. Where do you see where we are now, given what stage of the economic cycle we have in from your perspective?
Well, where the economic cycle is a big debate right now, right? I mean, there's lots of people calling for recession. Also, lots of people thinking this is just a mild slowdown, and it's in the thick of it is hard to know. But I can tell you that the bargains are to be had in cyclicals. Defensive have really been the areas where the market participants have been hiding. So, like utilities, consumer staples, their valuation did not pull back during the last few weeks. So, our shopping was done in the cyclical area of the market.
You took the next question right out of my mouth because I was actually going to ask you as a follow on areas that a value investor would usually go, but at the time might appear fully valued, if not rich. It sounds like utilities. Any other parts of the market? And is that limited to the US or is it also in, say, European or other in other markets?
European staples aren't particularly cheap neither. So, basically the parts of the market that have held out the most during all of this uncertainty, we find them to be the most expensive at the moment. So, if we actually get through the all of this uncertainty, and maybe a few weeks, a few months from now, where there is more certainty about trade policy and how the tariffs are going to go, what the end game is, then you're going to see capital likely leaving the defensive sectors to go into these really undervalued sectors, including cyclicals, including technology. So I think we are positioned for that. We believe what Trump is doing is sticking to his playbook 1987 out of the deal. Exaggerated bargaining positions, lots of noise, misdirection, all of that. He's doing exactly what he said he told people he would to do when negotiating. And the news flow seems to be indicating that, he does pay attention to the market. He does care about the economy. So that's what we are going to with in terms of our execution strategy. Look for areas that are really beat up, looking for return to norm, some sort of norm in the coming months and quarters.
My last question for you, Richard, as we talked about earlier in the conversation, 2025 has been a rough ride for many of the former high flying growth stocks. I'm just curious, as a value manager, is it possible if these Mag 7 stocks ever got to a level that was compelling to you as a value manager, would you consider building a position in them in the hypothetical?
So, uh, what's a value stock? A value stock is basically if I cover the name of the stock and I don't know what the company does, and I look at the cash flow, the free cash flow that it generates, and I get a present value of the free cash flow. If I can buy at 20, 30, 40% below that, that's a value stock. So the label that the market puts on different things, oh, that's a growth stock, that's a bar, those are just labels, right? I mean, I think Buffett said value and growth are joined at the hip. Ultimately, it's about what are you paying for earnings, what are you paying for cash flow. So if these stocks that come down hard enough and they are going to be trading below the intrinsic value that we believe they deserve, we will own them. They are good quality businesses. So that's the question: is about price.
Excellent. Any last parting thoughts, Richard, as we come to the end of our conversation? I've greatly enjoyed it.
I think this is a very interesting time. I think a lot of money could be made if people can stomach the volatility, because uncertainty is when you get prices really cheap, and when you buy things really cheap, that's when you get great returns, and that's what we're doing at Kundo right now.
That's fantastic. It certainly seems like the time for value has arrived. Richard, it's always great to have you on the podcast. Thank you for joining us today, and I'm already looking forward to having you back next time.
Okay, great. Thank you, Rajan.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may all be associated with mutual fund investments and exchange-traded funds. Please read the fund facts and prospectus before investing. The indicated rates of return are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.